Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin, the Chief Currency Analyst here at HYCM. Now I'll just make sure I'll show the main screen. There we go. Nearly forgot, just reminding myself at the right time. If you guys could just let me know if you could hear me okay as folks are coming in, that would be really helpful. Hi Sammy, good to have you. Great to have met you in Dubai last week. Good to see you here, and I'm glad to be able to put the face and the name together. So good to have you. Hi Ellie, Hashik, Van, good to have you back as always. Hi Misham, that's lovely. Thanks Sammy, thanks for letting me know you can hear me okay too. That's great. Okay, well we've got quite a lot to come in this session. We're in kind of a really interesting point in the market where it's kind of very quiet, but that's because there's a number of issues that are on the verge of perhaps being resolved one way or the other. So I feel in one sense we're sort of at a crossroads at the moment. So it's going to be quite interesting and hopefully quite a helpful learning time for you. Before we get going, just to remember, disclaimer. This is simply to say that the idea of this workshop is to give you guys the perspective of a professional trader to see the kind of factors that influence my trading decisions. The idea is that as you approach these FX week aheads, as you look at these online workshops, you'll get to a place where you will be able to make your own trading and investment decisions with confidence because you'll just know why the market is more likely to move in one direction than the other. It's as simple as that, really. And the kind of work that we do here is, so hi Tribivan, good to have you on board. The work that we do here is simply just trying to give you guys the tools so you can make informed trading decisions for yourselves. So that's the whole idea. That's why the disclaimer is there. What it is saying, this is not a signal service. So as we look at different trading setups, different currency pairs, you know, this is not an invitation to trade. It's an invitation to learn the kind of decisions that I'm making so that you guys can make your own informed decisions down the line, just to make that clear from the outset. Okay, so outline of the session ahead. What we'll be looking at is we'll be looking at the last few sessions and seeing where the market is at the moment as we enter the US session. The special topic today is going to be currency correlations. It's just something that's worth looking at. Just I was reminded just preparing this webinar that actually sometimes, particularly when people are beginner traders, they can end up doubling up their risk by trading a currency pair that's very closely correlated to another currency pair. So you might think, oh, I'm trading two different currency pairs, but actually if those two different currency pairs move in the same direction, then you're actually doubling your risk without realizing. So we're going to cover that and begin to look at that kind of situation for us. Going on, we have handout for the session. So the handout can be found on your go-to webinar control panel. Have a look there, you've got the handouts, just click open workshop guide. And when you double click the workshop guide, you should have a workshop guide that appears like this. And this, for those of you who've been following me for some time, will know that this is essentially the framework upon which I make my trading decisions. I look back, I'm wanting to see what the recent sentiment is in the market. I'm wanting to see what the recent fundamentals are. I look forward for any key upcoming market events, look at the charts, look at my risk, and look at the outcome of my trade. So that is the, my trading formula, if you like. And I've just typed it out here, one side of A4. The idea is that this complements the workshop. You can take this handout, print it out, put it by the side of your desk, and use it on a day-to-day basis as your framework and groundwork for making trading decisions. Okay, so we'll be referring to that as we go through the session. If there's anything you really want covered, say, there's a topic you're thinking, oh, I really don't understand how this works, or I'd really like to look at this aspect of trading, just email suggestions for topics here to myself. You can email me direct. And if there's a topic that you want to have covered, email it to me and I can always do that topic at one of our next times. I'm really happy to do that. And, the more notice you give me, the better, so I can do a better job. Turning to your handout, we'll start, and like all good stories, they start at the beginning. And this is always, always, always what you want to do when you come to the markets. I'm only, going back quite a few moons now. I remember when I first started trading from an FX retail perspective, like many of you guys, what I used to do is I used to open my laptop and I'd open up the chart straight away and I'd look for key technical areas to buy or sell. Now I do exactly the opposite. I open up my laptop and I'm wanting to see what has been happening in the last few years, few sessions, sorry. I want to know what's been happening in the last few sessions. And this is why this section here is so helpful. Identify recent sentiment by reading up on the last 2 or 3 sessions of market activity, and then identify the key market sentiment. And can you summarize that sentiment in a sentence or 2? So the whole idea is this, is you want to think, what is it that's gripping the market? What is the market focusing on? What has the market been moved by? And what is the market sentiment? Sentiment is simply mood. Moods can fluctuate, can't they? They can be an up mood and a down mood, and they change. And in exactly the same way, the market's mood changes, and it changes over events. Particular events happen, and that changes the mood. So we're going to start at the beginning by looking back and showing how this works in practice. And these kinds of the way you find this sentiment is you read up on what's called market wraps, and they're available widely across the internet, and they're available through HYCM on the website, and you can just find them virtually anywhere. There's so many different market wraps, and it's just currency analysts like myself who summarize the recent movements and the recent sentiment in the market. And what you want to do, you want to do that so you begin to identify that sentiment, and you can see what the market's focusing on. And it makes sense, because you don't want to be entering the market unaware of a key focus, because then you're going to be either missing out on a opportunity, or you're going to be moving into a difficult situation. Okay, so here we go. Looking back, yes, so starting with the handout. Yeah, some of the first things that we see recently is that China, I'll just get this on, there we go. China was, in the American session yesterday, was considering the US request to shift tariffs on agricultural goods. Okay, so that was, that move between the China and US trade war is very important. So this was a good move out of China, considering shifting some tariffs on agricultural goods. So that's a thawing, a warming in the relationship, but still not there with US-China talks. And the way to kind of understand this is, the way I'm increasingly understanding, this is my opinion, is that President Trump really wants US and China to resolve their trade dispute, because if they don't resolve their trade dispute, remember 40% of the world's GDP, this is the major drag on global growth, the difficulty between US and China. So the market's trying to work out, is this going to be resolved? Will the US-China talks solve? The sell-off in the equity sphere at the end of 2018 was on this concern about a US-China trade war, okay? So when Trump realized that that's how much it impacted the whole equity sphere, what Trump realized was that, oh, hang on, if I keep this trade war rhetoric going up, my S&P 500 is going to fall. And he gauges his success by how much the S&P 500 increases. So you'll notice straight after that situation, what he did is he then changed his rhetoric. And he started saying, oh yeah, we're going to solve the US-China war. I'm very warm, very optimistic about talks. Actually, drilling down into the detail, there are some sticking points. In particular, it's intellectual property rights. That is a very sticking point between US and China. And although the rhetoric from both sides is warm, the reality is it's difficult, it's tricky. So we're balancing this twin kind of feeling of optimism on one side and then realism on the other. And and the question is which one is going to resolve. The market doesn't yet know at the moment which one is going to resolve. Still not there with US-China talks. And the more time that goes on without any details about these US-China trade talks, that really coming through, the worse it's going to be. Okay, so that's just a backstory to be aware of. Hold it in your mind. Now we're now into US earnings seasons. So we had some US earnings coming out for various companies yesterday. Two of the biggest ones were the Goldman Sachs and Citigroup. Now Goldman Sachs reported a better earnings of 5.71 versus 4.89, but the revenue was worse than expected, 8.81 versus 8.99. Then we had Citigroup out with the earnings were good, 1.87 versus 1.80 expected, but the revenue was down, 18.58 billion versus 18.63 billion. So the way that was read by the market was, yeah, the earnings were good and beat expectations, but the revenue details were not as impressive. And so there was a little bit of weakening in optimism for the US economy concerning the downgrade in revenue. It's still early days for the first quarter earnings for the US companies, but that is a market focus. So the market is going to be reacting to the ebb and flow of that, and the more good data points that are released, the better that's going to be for risk. And obviously the Federal Reserve at the moment is on a pausing rate hike. So, the market's wanting to see really good growth from US companies, good earnings, good revenues. Okay, so just to be aware that's going to be a major catalyst at the moment. We also had the Fed's Evans speaking in the American session. He was coming out now, just to remind ourselves, the Federal Reserve at the moment is on a patient footing. Now, at the end of December, the Fed raised interest rates, but since the start of the year, the Federal Reserve said, no, we're pausing. We're not going to carry on raising interest rates, and we're not necessarily going to be cutting interest rates. They're kind of at a neutral point, and what the Fed keeps reiterating is they're data dependent. You can see some of the key lines coming from Fed's Evans yesterday. He was saying inflation is slightly weaker than he would like to see. He sees 2019 growth of 1.75% to 2%. Fundamentals point to growth, so that's a mild optimism. It's concerning that inflation is running under 2%. December hike was not a mistake. Reiterates data dependence can be data dependent until pressure leads to inflation. Would expect a negative shock to cut rates. Comfortable with monetary policy settings. So really what Fed's saying is that I'm carrying on this patient perspective. Okay, that's what he's saying. I'm carrying on, I'm patient. So there's no particular surprise there, but it just reminds us as currency traders, okay, so the Federal Reserve is data dependent. So in particular, inflation figures are going to be important for the future path of, American interest rates. So once we know that, what we want to do then is we want to have a look when is the next inflation data coming out for the US. So you mark that in your diary, you get that sorted, and you're thinking, okay, this is going to be particularly important. Start looking at that inflation data ahead of time. Okay, so here, just a reminder here. So this is the way we can start to put some of these things together. Fed is neutral and data dependent. Look at inflation data, it's a focus. Okay, so in our future research, we start marking that in, go to a calendar, find out when the next CPI inflation data is coming out for the US, and start using that as potential trading opportunities. Okay. In the American session, we also had the Bank of Canada Business Outlook. Now, this was quite a surprise because the Business Outlook survey indicator declined from strongly positive in the winter survey and is now slightly negative. So you can see that we've gone into a negative situation from the last time it was negative was around 2016. So that is a big softening in business sentiment, business mood, and you can see there the business outlook survey indicator. You can see the chart here. Okay, so it's gone from above 0 to above 2 point something, down to below 0. So that is negative sentiment for the Canadian dollar. Okay, and this was some of the major points from the release. Okay, so the previous was 2.19, then it was minus 0.6, so quite a significant fall. Okay, now this took me by surprise. I wasn't expecting this to be so significant as it was, and part of the reason for its significance is how wide those declines are. They're large declines. So this is the headline is the bank business outlook survey indicates decline from a strongly positive level in the winter survey and is now slightly negative. Okay, they talk about global trade headwinds and geopolitical tensions are affecting firms' operations. That's the thing to get in your head. The whole concern around for the markets at the moment is to do with global growth. Is the global economy shrinking? Was the global economy going to grow? And a lot of that is being underpinned by the US-China trade war. So that's why it's such a focus. The balance of opinion on terms and conditions for obtaining financing moved back towards an easing. However, most firms continue to report credit conditions unchanged over the past 3 months. If you look at the immediate reaction, US dollar, Canadian dollar rose from 1.3310 to 1.3346. So that's a 36 points instant reaction because the Canadian dollar weakened. Hence, US dollar, Canadian dollar strength. We also had oil at around the same time was also losing value. So that was underpinning US dollar, Canadian dollar strength. Now, the good thing for you guys to get into the habit of is get into the habit of looking at sources for yourself. Okay, so I'm just gonna give you the website here. Okay, for this source, just gonna pop it. Let's just see if I can. I'll try and pop this out for you all. It's not letting me do that. It's annoying. Let me try again. I want to type the answer. Oh, here we go. Yeah, here we go. There we go. I'm going to send it to you all, guys. I've just sent you a web link, and this web link gives you the actual source of the Business Outlook survey from the Bank of Canada. Yeah, let's have a look there. That should. There we go. Let's have a look. There we go. So there we go. And this is the actual report from the Bank of Canada. Okay, so get into the habit of reading it yourselves, okay? And you can see like the overview, and you can see the overview here. The indicator on past sales growth has moved down to near 0, chart 1, suggesting that the pace of sales growth has moderated slightly over the past 12 months. So you can see like sales growth, that's a really large, fall from plus 22% to minus 6% on sales growth. You can see, several firms are less optimistic about demand, a slightly smaller, there's a fall in future demand. You've got capital expenditure plans remain positive. Okay, that's good news. Employment intentions are healthy. That's still good. Pressures on production capacity. So in other words, how would you rate the current ability of your firm to meet an unexpected increase in demand? Okay, so the less difficulty people have, it means the more spare capacity they have. Okay, so companies have more spare capacity, and that can be a bad sign because there isn't the work around. Okay, and then you go down to the very end, and we have the business outlook survey indicator, and we have that. This is the main headline figure. So when you read these reports, and what you can do is you can start to get some really good information for yourself, and you can start to develop your own understanding and knowledge. And by developing your own understanding of knowledge, you will grow in your awareness. I can't really stress enough, actually, digging into detail is what's really going to help you in the FX world, because When you own and understand the detail, you see the deviation much more quickly, then you have the confidence. But don't worry if you're not there yet, it takes time. And also, don't give yourself the wrong expectation of trying to know everything about every central bank. You can't. It's just not possible. So you need to focus in on certain data points for yourself, and also get into the use of reading good analysts, and who can sometimes point out these good issues for you. Okay. So US dollar Canadian dollar pair, what would we expect to see with this really weak business outlook survey? We would expect to see weakness in Canadian dollar. So this was the reaction here. So saw the weakness in the reaction here. We saw US dollar Canadian dollar whack up about sort of 30-40 points. And we saw, this is the 15-minute chart, price retrace back to that pivot point, and then moved up towards the pivot point the next day. Now, if we were looking to carry on going, you could say the US dollar is a comparatively stronger currency than the other currencies. We have, let's have a look at oil. Oil at the moment is slightly retracing. We've got a 63.62 on oil, so there is a little bit of oil strength in the market, but not a lot of oil strength. We have the 100, 200 exponential moving average, and we have a pivot point here on the intraday chart. So, for example, what we might think is, if we think that business outlook survey, that sentiment is still in the market, we could look to potentially buy the US dollar Canadian dollar pair from these technical areas. And let's have a look where we are. Let's just pull up a chart, and we'll just go to the US dollar Canadian dollar pair. There we go. And what can we see? We can see, putting this together, we can see that, okay, price has we can see, look, putting the technical picture together, we have some support. We have a support level here, 1, 2, 3, and we can see price around the support level. We see price just bouncing off the 50 exponential moving average. We also have another support level down here, just around this area here, this zone. We've got the 50% retracement level. So looking at that chart, if looking to go long, I personally would be looking for around, let's have a look on the 15-minute chart. I'd be looking, yeah, this is the key level here for me, was this 1.3362 level. And in fact, I think I just missed my order. Yeah, 1.3360, let's see. 1.3360. Yeah, I just missed my entry. My entry was at 1.3360. So that's annoying. You can see how maybe in hindsight I should have just put it just slightly above that 38.2 level. But you see, that's the example of using that sentiment. Okay, US dollar is comparatively stronger. The Canadian dollar was weaker. We're looking for a pullback zone area, and you can see here that region, the 50%, 38.2% Fibonacci retracement level. We have the 200 exponential moving average, and we have here the pivot point on the 15-minute chart. That's how we put it together. We get the sentiment story, we get the fundamental story, and then we get the technical story, and we put it all together, and that's how we're trying to make a trade. Okay, that's the way to do it, and that was my attempt there. And you can see prices beginning to move up to the upside now as we speak. Okay, so I'm going to leave that now, because I've cancelled my order because I wanted to get in on that first retest. I didn't want to get in on a second retest. But further down, the 50% level looks good, and you can see here another potential entry would be way down here, down at the one just above the 1.3300 handle on this support zone here would be another potential, sound place to take a long on. Oil was in focus. There was 1% loss yesterday, so I'll just make that clear. And just want to look at oil and just give you guys a bit of a heads up. So there's upside risks for oil, and the upside risks are the fact that there's US pressure on Iran and Venezuela. Okay, so there's sanctions on Iran, there's trouble between the US and Venezuela. Iran and Venezuela obviously produce oil, and if there's difficulties with their output, then oil is going to increase. There's also instability in Libya. There's considerable civil unrest within the country, and with fighting near Tripoli, which has a lot of ports and the pipelines go there, there is concern that further Libyan instability will result in more oil upside. So that's the upside risks. The downside risks, and this is the reason for the loss yesterday, was that Russia was speaking about increasing their output. So there was some concern that Russia would up their output, and also long positions are 7-1 against short positions. So it's starting to get a crowded market, and you tend to get, when the market is really positioned one way, there reaches a point where people take profit. Those positions, there's no fresh people to take longs, and you start to see price retrace. So that's some of the downside risks. We've got private inventories out tonight for oil, so be aware of that private inventory data. That is reported on forexlive.com, and I think they often get it from Zero Hedge. So that's a couple of the sources there. Just to remind you, this is the seasonal chart for oil. Okay, so February, March, and April have all been very technically, so fundamentally, are generally very good for oil. That tends to be a good seasonal trade. Okay, and you can see October, November, and December. You can see that tends to be worse for oil. So oil is quite seasonal, as you kind of expect with a commodity like oil. So just to be aware that we're approaching the end of a strong seasonal period for oil. So I'm beginning to think about oil potentially topping out. You've got OPEC, who are meeting in June. Will they increase production cuts? Not sure. So if they increase production cuts, then we could potentially see oil carry on to rally. We may see oil just retracing at the moment. So I'm kind of neutral on oil, and I'm neutral to bearish for those reasons that I've mentioned. Although, what would change my view would be, say, further trouble from Libya, further difficulty for output from Venezuela or Iran. So you can see there's this seasonal picture, there's a fundamental picture. So it's quite, in my view, things are quite balanced at the moment. But what I'm looking at to give me a trigger one way or the other is I'm looking at the fundamental picture. In particular, what's happening in Libya is going to be important, and particularly what happened at OPEC in June. So that's just a heads up on oil. Asian session overnight, we had the US with pushing its allies to keep Huawei out of misspelling, out of 5G during meeting next month in Prague. So again, this is some of the tensions between US and China playing out versus Huawei. So US are going to try to keep Huawei out of the 5G network. The big sort of Australian news out was that our Reserve Bank of Australia minutes came out, and those minutes showed that a rate cut will be appropriate if inflation stays low and unemployment trends up. So this is what we're trying to do. For those of you who have attended these seminars for a while, or those of you who were with me in Dubai, that the central bank wants to communicate to the market what it's trying to do so that it keeps currencies stable without undue fluctuation. And so the Reserve Bank of Australia has literally told us that, if inflation stays low and unemployment trends up, then they're going to be cutting rates. Okay, so we can, again, this is a really good habit to get into. here's the website. I'm just going to send it to everyone. Now, what you do is when you I'm just going to call it up. This is the website, and these are the minutes here. Just you can actually look at the minutes yourself. And the Reserve Bank of Australia's minutes are actually really helpful because they give you a kind of a rundown of what's happening across the whole global economy. They talk about China, they talk about the other world central banks, talk about United Kingdom, European Union, Japan, the US, China. So you put all these together, and the minutes are quite good just for giving you an understanding of some of the pressures that central banks are feeling across the world, and you get the expectations of what they're trying to do. See, members agree that inflation was likely to remain low for some time. That's no surprise. They're quite optimistic of inflation in the Australian Reserve Bank of Australia, and it's been low for a long time. Wage growth had remained low. There continued to be strong competition in the retail sector, and governments have been working to ease cost of living pressure, including through their influence on administered prices. In these circumstances, members agreed that the likelihood of a scenario with a cash rate would need to be increased in the near time was low. So they're telling you, they're not looking at increasing the cash rate. And essentially what they've mentioned that labour is strong, but growth is low, okay? So they've got this kind of, maybe here, the labour market had continued to improve in early 2019, despite the slowing in growth according to the national accounts. So employment had increased a little in February, following strong growth in January, and the unemployment rate had declined to 4.9%, continuing the run of months with an unemployment rate at around 5%. So really, what they're saying is they're putting confidence in their labour market, and they're concerned about inflation. So what that tells us, you can read through this at your own leisure at some point. What this tells us is a couple of things. It tells us that if unemployment increases or the wage data is bad, then a rate cut's going to be appropriate. If the inflation stays low, a rate cut's going to be appropriate. So that is what to look out for. We want to look out for inflation data, which is coming up on April the 27th. Pop it in your diary. I want to look out for employment data coming up on April the 18th, which is this week. Okay, so straight away, we have a good heads up that this week, this data point is going to be of greater importance to the Australian dollar because the central bank has highlighted its importance. Okay, so they've talked about a strong labour market. So if the labour market weakens, what would we expect the Australian dollar to do? Let me know, guys. Come on, tell me so you know this. What would you expect? Exactly. If the employment data is bad, what it's going to tell us is that the Reserve Bank of Australia are going to be more likely to cut interest rates, you see? So it will be a sell Australian dollar. So poor and weak employment would be a sell Australian dollar. And if it's a large deviation, it will be a sell an Australian dollar at market. In other words, you'd enter in straight away, okay? So, this is the thing we want to get into. We want to see what potential opportunities are ahead, okay? And this is a key opportunity, okay? One to watch out for. This was like a bank talking about the Australian meeting minutes. It said board has made it a clear case for the benefits of lower interest rates. Discounting arguments suggest that it sees little benefit from lowering rates given the very low starting point. The board also clearly lays out the conditions for those rates around inflation and the labour market. It appears that it has resolved the uncertainty around the conflicting signals from growth and employment by favouring the labour market. Okay, while prospects for a policy response in May have disappeared, there's still ample time and data releases justify our timing that there will be cash rate cuts in August and November. WPAC sticking to August for a first cut. So in other words, what's going to justify their view would be weak employment data. That's the focus. That's what we want to look at. So out of New Zealand, we've got Reserve Bank of New Zealand's OR saying the New Zealand dollar is currently around a happy space. The Reserve Bank of New Zealand's easing bias remains in place. So what they've said, monetary policy easing bias remains in place for now. Softer economic conditions in US, Europe, China contributed to the dovish tone. Possibility Q1 inflation undershooting forecasts already factored into banks' dovish bias. Says New Zealand dollar currently around a happy space. Obviously, a lower New Zealand dollar helps the export market within the New Zealand economy. Now, just to be aware, I think I printed that out, but you can go back and you can see the Reserve Bank of New Zealand's bias, that they are looking more likely to cut rates. That's what they mentioned in their last monetary policy. So the inflation data is out this week again. It's actually out this evening. So just to be aware of that data point, okay. That's coming. So it's interesting to see he's talking about Q1 inflation undershooting forecasts already factored into banks' dovish bias. I wonder if he's already seen the data. That could be a little clue that the inflation data is going to be low. Had some details about the Bank of Japan. Governor Kuroda saying we'll consider further easing if momentum towards 2% inflation is lost. You know, so they will consider easing. One of the largest easing programs in the world has come out of Japan. So the fact that they might consider further easing, really what he's saying there is that's something to pay attention to, because when a country uses quantitative easing, it weakens their currency. So this is just a hint that the Bank of Japan is saying they might consider easing further, although there was a note from an investment firm that said even though they have said they will ease more, he says that it may not be possible to do, and he gives the reasoning there that the central bank already owns just under half of the Japanese government bonds outstanding and more than 3/4 of all outstanding exchange traded funds. So investors are already complaining that intervention has hindered market function. As a result, the bar will be very high for further easing, leaving the ground open for the yen to appreciate. So that's just the governor's, rhetoric and potentially the market reality. So there may be more pressure to actually ease. So in other words, this isn't new stuff from the Bank of Japan's governor. If this was new, then it would potentially move the market, but it's not market moving because it's not new and people know that. Okay, now coming into the European session. In the European session, there was some pressure on the euro early on, with European central bank sources saying that several policymakers have doubts about projections for growth rebounds in the second half, and they've been questioning the forecast models. So there is a significant minority expressing their doubts that euro growth will continue. Will not continue, will recover. It's always been the line out of the ECB, is that eventually growth will return. They were saying that in 2018 and the growth didn't return. And now they're still saying it in 2019. And so some people are beginning to question their forecasting models within the European Central Bank Board. So this is significant. And we have some PMI data out of the Eurozone coming up this week. We'll look at it in more detail in a minute, but it's a potential another trade opportunity setting up here with a bearish euro sentiment on any more weak PMI data. Just so the options, there were some large options expiries at 1.3100. What I do is on my Twitter account, which you can just go to, my Twitter name is Giles Coughlin. On my Twitter account, like today, I just highlighted where the large option expiries are. We covered this not last week, the week before last, before I went off to Dubai, and we looked at learning about option expiries. Today there was one large option expiry at 1.3100. Okay, and these option expiries, I'll just very briefly go through what I went through a week and a bit ago. Is, you know, you can look at the previous webinar to get the information here. But basically, there are different types of expiries: a vanilla, a barrier, and double no touch. The options I report on are vanilla options. And what you want to look at, an expiry option level that's above $1 billion tends to be significant, okay? And they kind of work like magnets. They kind of contain price and they hold price. And what you're looking at is these large expiry options, and I'll show you like kind of how they work. So you look at the pound. We'll look at the pound US dollar pair for today, and we saw it was at the 1.3100 level. Oops, a daisy. There we go. So this I posted this around sort of 7 a.m. ish. Let's have a look. Template. Giles. There we go. Right. So they're valid until 2 p.m. GMT time. Okay, that's when they're invalid. So you can see that the kind of option expiry level is here. Okay, 1.3100. Just there. This is the option expiry, and you can see that that level operated. You know, let's give it a 10-point window. You can see that level kind of operated to contain price. Okay, so it kind of works as a magnet. It draws price to it, and we're looking at the price action around it. So you can see here, like the 15-minute chart, sold off, sold off, sold off, all pulling away from this option expiry level, and we've now got the option expiry level just about to expire. Okay, it's just coming up to 2 o'clock GMT, and that level will expire. So that's just something to be aware of. Okay, how they work. The large ones, so you're going to be aware of them. So what you wouldn't want to be doing was, you know, if you were trading long on the pound US dollar, trying to go through this 1.3100 level, you could have realized actually that's not sensible. I don't want to go through that level. I would want to take profit either at or just before that level if you're going long, because you know that 1.3100 is likely to contain price. Okay, so that's just something to be aware of. But as I said, you can look at them. You know, just come each day to my Twitter account, come to the website, have a look, and you can get into the habit of how they contain price. And you see here large options expired for today's New York cut. That is 2 o'clock GMT time each day. So I'm reporting on those vanilla options. Okay, European session. We had some more German April ZEW survey, more negative sentiment, getting down to the 2014 lows. Okay, so either equal to or lower than, not quite lower than, but approaching the lowest for 5 years. So quite negative. Obviously, this is concerns about global growth. Prior was 11.1. Expectations were 3.1 versus 0.5 expected. So you just got that lower reading than was expected. We had Eurozone February construction output. Now that increased plus 3% versus minus 1.4% prior. Okay, so that's a little bit of an uptick for Eurozone construction, but not so much a surprise here because we'd already had the good construction figures out from Germany, okay, because Germany's industrial production had come out in February, and look, their construction was 6.8%. So a big jump in construction. That was the saving grace for Germany's industrial production. But the thing to remember is that Germany is the largest country in the European Union. So Germany's data has a strong impact on the whole Eurozone as a whole. So just to be aware of that, particularly as we're looking at PMIs coming up, we want to look at Germany's as being particularly influential. Largest Eurozone country, biggest influence. Okay, we saw that the Japanese yen was leading, was the strongest, and Australian dollar was the weakest going in to the close of the European session. European equities mixed, up 0.3%. Remember, you want to see equities up or down 1% have the most impact. 10-year yields up, gold down a little bit, oil was flat, and Bitcoin up 0.7%. Again, remember with gold, what the market's trying to work out, I'll just flick up the gold chart, is, you know, what are the central banks going to be doing? Are they going to be raising interest rates, or are they going to be cutting interest rates any further? That's what is trying to be worked out by this situation. So let's have a look here. Yeah, so you can see here, we're starting to see gold breaking out of these daily lows. That, you know, very significant. So really significant point for gold. Moving down the 200 exponential, moving through the 200 exponential moving average, down past the 1, through this key support level here. If we better break and close below this level, we're opening up considerable more downside. I'm thinking, do we have a reverse head and shoulders pattern there? I think we have. We've got a head, shoulder, shoulder. So yeah, we've got a head and shoulders pattern forming there, nearly, very closely, head, shoulders, neckline. So we could be looking at extension from there to there, which would be, you know, you can do the extension, but from this point to that point, so 1215, if we get a further breakdown here. And what the market's trying to work out is, okay, is the Federal Reserve done with cutting interest rates? Because, you know, that's what the market's trying to figure out, and that's what this trade out here is in gold, is if global growth is going to keep supported and isn't going to shrink, and the Federal Reserve isn't going to be cutting interest rates, then we're going to see gold lose its value. That's the trade here. That's the thing to keep in mind. And similarly, the trade I looked at for the FX week ahead on Monday, you can go back and look at that. But again, it's the Australian dollar Japanese yen chart. Okay, this is a really good proxy for risk, because in a risk-on environment, you're going to see the high-yielding beta currencies increase, like the Australian dollar, and you're going to see the Japanese yen weaken. And this was a trade that I entered, and I entered just down here at, let's see, at 79.99. So I entered here just underneath that 80 handle, and I just put my stop below the low here, because this was just technically a very sound place to enter. You also look at TradingView. I'll just show you. There is also a pivot point down there as well. This was a trade that I was flagging up yesterday on the FX week ahead, and there's quite a lot of potential upside here. And there's going to be a key catalyst, which is going to be the GDP data out for China that's coming up. So we're going to get a push one way or the other for this. It's just about to come out. Yeah, let's see. Yeah, there it is. Okay, I'll show you that here. This is the. You can see I've marked it here on the chart. I've got it still here. This was the Australian dollar Japanese yen pair, and you can see here there was the pivot point here, just at this 80 level, 100 exponential moving average, a pivot point, very key place to go long from, and then you can target 81, 81.50 and above. Okay, so that's that trade there, and that's again on this global growth rhetoric. Okay, so. Looking at the so we want to still focusing, like, what does that mean for us as traders? We want to coming up, employment change, unemployment rate, important. Pop it in your diaries. Stay around for it. Okay, Thursday, April 18th, 2:30 a.m. GMT time. You want to be looking at that. Okay, so guys, make sure you've got that marked in. It's going to have an action, and if you get a real big movement then you're going to see that. Oh yeah, okay, Tribuvan, sorry, I've just seen it. Okay, right. So Nadir, sorry, Reserve Bank of Australia says if employment trades up, then cut rate. No, they're saying not as explicitly that, Nadir. What they're essentially saying is that there's two sides of the equation. Is that the importance for them is employment and inflation. If inflation remains weak, and if employment is weak, there's more unemployment, there's not so much employment going around, then they're going to be cutting rates. That's the more likely scenario. Remember, these guys are forecasting, so they're not necessarily being as explicit as that. But basically, if we see a really weak employment number out on Thursday, April 18th, we want to take notice, and it's a sell Australian dollar at market if it's a weak enough employment data. The other thing, okay, Trib, employment data is positive, then why pound is under pressure? The employment data wasn't so good for the pound. It was just expectations, the wages data. It was just pretty much what was expected. So, there wasn't anything to particularly surprise or move the market one way or the other. So Trib, there just wasn't anything that was like really big or outside of expectations. So nothing expected there. I'll just skip that to running out of time. Looking forward, again, this is where opportunities are, guys. Looking forward, there's quite a few. So we've got the CPI data that's coming out of New Zealand. Now, this is important. We're buyer short due to the Reserve Bank of New Zealand. Sorry, just make sure you saw that. It's out tonight, 11:45 p.m. Okay. We're buyer short because of the Reserve Bank of New Zealand's dovish move in March. Given the weaker global economic outlook and reduced momentum in domestic spending, the more likely direction of our next official cash rate move is down, shifted. They've shifted to a negative sentiment. So in other words, if we get like a really big low CPI number, you could sell at market. So say it's 0.3%, say you got like, minus 0.2% or minus 0.1% or even 0%. That's an instant sell at market New Zealand dollar, and just take, some pips out of the market. Don't get greedy, but you can just take some pips and then you can try to re-enter on a retrace. Looking here, yeah, remember, go to this address because the Bank of New Zealand focuses on this sectoral factor model. So you need to be aware of that, okay? So I'm just going to send it to you all now. Okay, here's the website. Go to this point and you get the sectoral factor model. So just check that as well at the same time. And you don't want to see that deviating much from anything else. This is what the bank is focusing on, that sectoral model. So if that sectoral model is contradicting the headline, the bank said they're going with their sectoral factor model. That's the one they like, okay, just to be aware of that. Okay, Thursday, we've got, there's a lot going on, isn't there? We've also got Chinese GDP data. That's going to be a catalyst. Again, the proxy currency trade for trading the Chinese yuan is the Australian dollar. What's good for China is good for Australia. What's bad for China is bad for Australia. You've got the correlation. Then we have Thursday, April 18th, we've got the employment change data. We've gone through why that's important. One to highlight, stay up for, set your alarm, 2:30 a.m. Then we have the PMI data coming out. Got a series of them for the Europe French, German, and the Euro flash manufacturing PMI. German, key. You've got the manufacturing and PMI coming at the same time. If you see a really low reading again there, sell euro on the release. It's a key thing, and then if it's then take a few pips, don't get greedy, then look to re-enter on the retrace. And obviously got some Canadian data and US dollar Canadian out, but my focus is the euro PMIs. Looking at the charts, obviously we've looked at the bias for certain currencies. We want to get into a habit of doing this, pairing up weak and strong currencies, writing them down. We looked at the US dollar, Canadian dollar pair. We looked at that. Keep trying to do that, and then look for key technical places to enter. Currency correlations, very briefly. This is when one currency pair rises and another falls. This is currency correlation in action, or it's when one currency pair moves in tandem with another. So you can go here to babypips.com and look at these currency correlations. Basically, some currencies have a perfect positive correlation. In other words, they move in the same direction, and some currencies have a negative correlation. They will move in the opposite direction 100% of the time. So you just need to be aware that some currencies move in partnership with others, some moves in opposition to others. And the reason this is because you could be doubling your risk without knowing it. So if you're trading multiple currency pairs in your trading account, always make sure you're aware of your risk exposure. We cover risk quite a lot, and this is another area of it. So for example, if you're trading the Australian US dollar and the New Zealand US dollar, it's like having two identical trades open because they usually have a positive correlation. Okay. So you might think, oh, I've got a diversified trade. I'm long Australian US dollar and I'm long New Zealand US dollar. No, potentially you may have increased your risk rather than diversified it. So just to be aware of that, I'll show you why. Look, here's an example: the euro US dollar and pound US dollar. Okay, so here's the 4-hour charts, and you can see that the currency pairs are moving in the same direction. The euro US dollar, the pound US dollar are moving in the same direction. So if we have a position short euro US dollar and short pound US dollar, you're essentially doubling up in your position. Okay, so be aware of these currency correlations. Here's some of the big ones. You can take a screenshot here. These are currency pairs that typically move in the same direction: euro US dollar, pound US dollar, euro US Aussie US, euro US New Zealand US, dollar Swiss, dollar yen, Aussie US, New Zealand US. They typically move in the same direction, so don't double up. If you want to spread your risk between the currency pairs, that's a different matter, but don't just open the positions thinking you're diversified when actually you're not. Okay. Next thing is currency pairs that move in opposite direction. So euro US dollar and pound, and so euro US dollar and dollar Swiss franc opposites, pound US dollar, dollar yen opposites, US dollar Canadian dollar, Aussie US dollar opposites, dollar yen, Australian dollar, US dollar opposite direction, and pound US dollar Swiss franc. So they're opposite directions, to be aware of that. We've looked at expiry levels, and I'll be doing that on a week-to-week basis. Before we close, don't forget the opportunities that we have here at HYCM, and some of those opportunities are one-on-one coaching with myself. If you deposit $1,500, you get an hour with me. $3,000, 1 hour with me and 1 hour review session. $10,000, you get a 2-hour coaching session, 1 hour follow-up, and 1 week VIP support with myself. So guys, that is some of the options. We've got some time for questions. So if you guys have got any questions, yeah, thanks Trib, that's great. You can look up these currency correlations, Google them. My main purpose today is just to get you aware of them, that there is these currency correlations if you weren't aware, and if you are aware, just to remind you. It's always good to be reminded, and it's where things get cemented into our mind just by going over things sometimes. So guys, that's been a really good session. There's a lot coming up. I just want to briefly, just quickly look at the calendar, just to go through it before we finish, because I don't want you to miss these opportunities. Where is it? Here we go. Yeah, here we go. So the New Zealand dollar CPI data coming up 11:45 p.m. tonight. Look at it. It's an interesting one. And GDP data out of China, going to be very significant potentially. If you get a good beat on this GDP data, that's going to be solid for China. China has been easing recently, so it'd be interesting to see if that flies through into their GDP. And then on Thursday we have the employment change data out of Australia, and then on Friday and Thursday as well, we've got the PMI data points. So the real good opportunities this week, okay guys, so look out for them, and they are CPI data tonight, GDP out of China, employment change out of Australia, and manufacturing PMIs out of Europe. Guys, I hope you have a really good week. I hope this is helpful. I hope you make some picks. Remember, if you do enter at market on a deviation, don't get greedy. just trail your stop in a 1 minute chart, or take 40, 50 points and then just accept it. Yeah, time changes. Yeah, time changes are tricky. Go to a Google Calendar, and just put in, these are GMT times, and just make sure they match to your time zone. It's annoying because we have British summertime recently, Nadir, and that's been confusing me as well. So I've got to keep thinking myself as well. Guys, have a really good week. I hope you have a really good time. I hope you manage to make some pips, and I hope to see you. Remember, next week at the FX Week Look Ahead, and we'll look at some more opportunities for the coming week. Yeah, cheers, Trubavan. Take care, guys. See you, Sammy. See you, Nadir. See you, Femi. You're welcome, Aaron. Take care now, guys. Goodbye.